Hello, my name is HenroidFX Academy, CEO of HenroidFX Academy. I want to thank you for your support and for your patronage, all my clients and students out there. Of course, you all know HenroidFX Academy is an institution that trades, that train, and also manage Forex accounts for clients. I want to welcome you to my Forex educational video series, and thanks for watching the past ones of this video series, where we discussed the first avoidable mistakes that we Forex traders make. And before I continue, I'd like to make a passionate appeal to you to encourage me by liking this video or subscribing to my YouTube channel. And also, as much as possible, you can make questions. You can write your questions down, send it to me, and I'll reply them, and let's interact during the course of the video, or maybe after the video. Perhaps you want me to make one or two explanations to you. I will gladly do that. So please click the like button and also the bell button, so that you can always get more notice or probably access to future video presentation that I will be present. Thank you. 6, which is taking profits too early. Now, this is a case where you need to learn how to lock in your Forex trading profits. It's a serious challenge, I know that, but I think this is where the discipline and patience also comes in. One of the most common problems for many traders is learning when and how to cut losses and hold on to winning Forex trades. In other words, not taking premature profits or cutting a profit trade too early. Have you ever asked yourself, should I take profit now or should I let it run in the middle of an open trade? Perhaps there were times when taking profit early proved to be a better decision. But I'm also sure that there were also instances when you get angry with yourselves for closing your trade too early. You closed at 15 pips, for example, at 10 a.m. And at 11:36 a.m. you discover it was already 65 pips. My God, what do? Let's see why the traders tend to cut profits early. Anyway, let's see the reason why. Here are 3 possible reasons. Number 1, they have no clear profit targets in mind. Yes, if you really had a profit target in mind, it's either that target or nothing. You won't cut it. You can only move a break even or a stop loss to a break even level, or maybe you do a trade profit, but not that you cut it and say, well, it may go. No, you don't do that. There's nothing wrong about determining your profit target as your trade plays out. It's just much easier to stay on the trade with a clear profit target, as it's easier to finish a task with a goal in mind. Number 2, this set of people have a low tolerance for risk. A trader's lack of appetite for risk may also contribute to premature profit taking. Some traders would rather have that sense of certainty and bank in at a profit of $100 rather than risk a portion of their own realized profit for another $50. That's it. Low tolerance for risk. Oh, this amount, no, I can't go beyond this amount, because you've not fixed that risk level. If you have fixed it, oh, I'm ready to risk $10, I won't be worried when I see $8.5, because it could just get to $9.2 and then you see a quick reversal. You have just cut your trade around $8 because you were afraid to get to $10. For me, I have agreed. My tolerance risk, $10 loss per trade. No problem. I put my stop loss there. All my conglomerate of stop loss will be at that level. Number 3, they are not confident with their trade idea or trading skill. Perhaps they already have a trade idea or they are good in trading, but because there's no confidence, holding on to your trade until price reaches your profit target requires not only a great deal of patience, but also a considerable amount of confidence. So number 1, they have no clear profit targets in mind. That's why I see them take their profit too early. Number 2, they have a low tolerance for risk and they are not confident with their trade idea or trading skills. So you need to make up your mind. What's your stop loss? What's your take profit? Fix it. Have a proper tolerance risk. What is your risk that you are willing to give out if perhaps it hits stop loss? Be ready, make up your mind, be fixed. 3, they are not confident with their trade idea or trading skills. You have developed it yourself, and you must have done your back testing. Why are you afraid? Set it, stay by it, hook, line, and thing, make sure you follow it to the core. It doesn't help that as you watch your potential profits grow, it gets even more tempting to to lock in those wins rather than risk the possibility of losing them by keeping your trade open. A potential loss of unrealized profit is the frustration that often accompanies these missed opportunities that hold the trader back. As traders, we tend to be too hard on ourselves, especially when paper profits vanish into the thin air. Maybe we cut our profits short to avoid blaming ourselves in the event that we lose unrealized profits. Honestly, much more confidence is required to hold on to a winning trade as it goes in your favor. That's just it. You have that confidence. You have done your technical analysis, and you saw, combining your fundamental and technical analysis, that this resistance zone, this support zone is a nice one. It's been tested over the time. Who says at that point your trade won't test that zone? Be confident. Be confident. Much more confidence is required. Yes, I know. You must develop that confidence. The challenge then becomes, how exactly can you achieve this level of confidence? I'd like to discuss with you how you can learn to trust yourself and have this confidence. Yes, it's that simple. Unfortunately, it's not as easy as it sounds to develop this confidence in yourself. You must be able to trust your trade idea so much that you stick to the plan and hold on to your trades until they reach your planned profit targets, right to the end or break even. Dr. Steinberger says that building self-trust can be accomplished in two ways. Number one, instill a confident mindset. And this is the part where you mentally prepare yourself in case price retraces and your paper profits are erased. It happens. But that's where the professional discipline stands. While some prevent it by putting a break even, while some trail profit. When you are in a trade, for example, you determine the possible retracement areas by using resistance and support zones and set your trail stops accordingly, like I just said. There will be times when you will get stopped out by fake outs and retracement turn reversals. Don't beat yourself up over the lost profits. Instead, remind yourself that you have done your due diligence and that there are other opportunities to take advantage of next time. After all, you will still trade tomorrow, you will still trade next tomorrow, from Monday to Friday. Build on small changes. For instance, you can try locking in some of your profits at some point and leave the rest open, either to hit your profit target or your stop loss. This way, you are able to realize profits and at the same time exercise confidence in seeing your trade until the very end. It's not every day that the market goes your way. But when it does, wouldn't you want to make the most out of it? Take advantage of it. Let it get to the very end rather than cut it away. So like you have seen, to build your confidence, you need to instill a confident mindset in yourself and then build on small changes as they come on your way. Make the most out of it. It doesn't help that as you watch your potential profits grow, it gets even more tempting to lock in those wins rather than risk the possibility of losing them by keeping your trade open. A bird in the hand, they say, is worth more than two in the bush. So they say. In summary, plot your resistance and support zones on your D1 time frame, your daily time frame, and also on the current time frame that you are about to trade, either 15 minutes or 10 or 5 minutes or 1 hour or 30 minutes. Find the coinciding zones and respect those zones as major retracement levels. Open your trades and apply your stop loss, and then you take profit, either 1-to-1 risk reward ratio, 1-to-2, and so on. Move your stop loss to each retracement level as the trade proceeds positively, or apply trailing profit of 1/3 the ATR level. It's important. Be bold and trust your analysis to a fault. Let anybody say what they like. Trust your analysis. You did this analysis on Friday and on Saturday. You did it on Sunday. In fact, you did it in the morning before you started trading on that currency pair. Trust your analysis to a fault. Be confident in your analysis. You're the best. Trust your analysis to a fault. It gives you that boldness and gives you that joy when you get it positively. Number 7, letting losing positions ride too long. Managing and preserving your trading capital should be your most important job as a trader. But if you look at this, I've seen students come back saying, it was a $10 You know what some do? They move the stop loss away. The original agreement was that at 10 pips, hits the stop loss or reverses, whichever one. But it was moving against them. It's about to get to the stop loss, get the relief, and then decide if you go the other way or you wait for the next entry, target. Instead, they keep moving the stop loss. $10 becomes $11 negative, $12. They keep moving the stop loss. So they change the risk management plan even twice in the game. For example, I'm willing to risk $10, then increases it to $20. On and on and on and on like that. That's dangerous. So you must not allow losing positions right too long. If you lose all of your trading capital, there's no way you can make back the lost amount. You are out of the trading game. And if you make pips, you got to be able to keep those pips and not give them back to the market. But let's face it, the market will always do what it wants to do. Even if you are the best trader or whatever you think you are, as far as I'm concerned, the market will always speak to you, tell you what it's about to do. If you look closely, and it will move the way it wants to move. It's either you move with it or you move against it. Every day is a new challenge, and almost anything from the global politics, major economic events, to central bank rumors can turn to currency prices one way or another faster than you can snap your fingers. These things all put together can make a huge change in the forex prices. This means that each and every one of us will eventually take a position on the wrong side of a market move. Everybody, be you a professional like me, whichever one, you will always have a wrong side. That's a fact. Number 7, like I said, do not allow losing position right too long. Being in a losing position is inevitable, but we can control what we do when we are caught in that situation. You can either cut your loss quickly, or you can ride it in hopes of the market moving back in your favor. Of course, if it doesn't turn your way this time, your account could be blown out and your nice trading career ends in a flash. You've been doing well, but one single trade you were hoping and you didn't cut it cleans up your account. The saying, live to trade another day. It's a natural thing we hear, generally, like in the James Bond 007 film, live to die another day. It's wise to live to trade another day. Save your capital. This should be your motto of every trader. It should be your motto. Always remember, I need to trade in such a way that I will live to trade another day. Or newbie adler, because the longer you can survive, the more you can learn, the more you can gain experience, and the more you can increase your chances of success. Now this makes the trader management technique of stop losses a crucial skill and tool in a trader toolbox. Take for instance here, buying here, and it goes against you, to the other side. Why don't you just, this is where you have placed your stop loss order. Don't begin to move it with the hope that when it gets here, then it will reverse. Unfortunately, you can see it got here and continued downwards. It didn't, as you would have expected that here it will do what? It will reverse. It did not. That's why he was wise to have stopped it at this point. This makes the trader management technique of stop loss a crucial skill and a tool in a trader's toolbox. Having a predetermined point of exiting a losing trade not only provides the benefit of cutting losses so that you may move on to new opportunities, but it also eliminates the anxiety caused by being in a losing trade without a plan. Now, before we get into stop loss techniques, we have to go through the first rule of setting stops. Your stop loss point should be the invalidation point of your trading idea. Remember that time you went on a blind date. At some point you had enough and just wanted to leave. That point you decide, oh, I'm okay, I guess we can leave now. That's a stop loss in the dating game. You're not going to be in the restaurant for a whole day. You're not going to be at that movie center or that theater for a whole day. At that point you decide to leave. It's the same way when you're trading. This is the point, I'm ending this negative trade. But a stop loss in the trading game isn't that much, it's not that much different. When the price hits this point, it should signal to you hey trader, it's time to get out. It's time. The main purpose of a stop loss is to ensure that losses won't grow too big. No, it shouldn't grow too big. While this might sound obvious, there's little more to this than you might just assume. Yes, there's little more. There are some calculations, depending on your capital, depending on your trading formula, and so on. Imagine two traders, James and John. The stop loss size for both of them is 20% for James and 2% for John, respectively. They both trade the same exact trading strategy, with the only difference being their stop loss size. For each trade, the trading strategy only has two possible outcomes, either a profit or a loss. This means that the strategy exits a trade when stop loss is hit or when take profit is hit. No stopping in between. Now imagine that both James and John go on a losing streak. They both lose 10 trades in a row. John's account will be down 20% because he's using 2%. 2 times 10 trades in a row, 20% down. But James has blown his account out. How? 20% times 10, that's 200%. The money is gone. James is out of the Forex game. The account is gone. Money is gone. He may be good at trading. It's gone. But the other guy, John, will still be in business. And who knows, the next day he would make more profit. So he's wiser. Using a stop loss decreases the risk of blowing your accounts and work to protect your trading capital. There are 4 methods you can choose from in trying to apply a stop loss. You can use the percentage stop, the volatility stop, chart stop, and time stop. This I will explain in another video because of our time, and I essentially explain this to my students during the Forex Master program.